Most people think a market crash is the moment wealth gets destroyed. But that's not actually what happens. A market crash is the moment wealth gets transferred from emotional investors to disciplined investors. And in the next big downturn, that transfer is going to happen again. A lot of people will panic. They'll watch their portfolio fall, convince themselves that this time is different, sell at the worst possible moment, and then spend years trying to recover from a mistake they made in a few emotional days. But a smaller group of investors will do the exact opposite. They'll stay calm. They'll keep buying. They'll use compounding the way it was actually meant to be used. And when the market eventually recovers, they won't just get back to where they were. They'll come out ahead. In this video, I'm going to show you how to set up your compounding system so a market crash doesn't ruin your progress. It accelerates it. We'll break down why crashes are so dangerous for unprepared investors, the 3 moves you should make before the next downturn starts, and the key mindset shift that separates people who build wealth from people who keep interrupting it. If you want your money working hardest exactly when the market gets scary, this video is for you. Welcome to MatFin Lab. Let's get into it. Most people hear the word compounding and think of one thing: time. And they're not wrong. Compounding is what happens when your returns begin generating their own returns. Over long periods, that snowball effect can become massive. It's the engine behind long-term wealth. But here's what most people never fully understand. Compounding is not just about earning returns. It's about staying in the game long enough for those returns to stack. And that's where market crashes expose weak investors. Let's say you invest $10,000 and it grows by 10% in year 1. Now you have $11,000. Another 10% in year 2, and you're at $12,100. So far, everything feels great. But then year 3 comes and the market falls 40%. Now your portfolio isn't slightly behind. It drops to $7,260. That means a 40% decline didn't just erase your gains. It pushed you far below where your compounding path was heading. And here's the part that really matters. To recover from a 40% loss, you do not need a 40% gain. You need roughly 67%. That is the brutal asymmetry of losses. Losses create a deeper hole than most people realize, which means every bad emotional decision during a crash has an outsized impact on your long-term wealth. So the real goal of compounding isn't just to earn more. It's to avoid interrupting the process. Because the biggest enemy of compounding is not volatility. It's investor behavior. A lot of investors act like crashes are some rare financial apocalypse. They're not. Market declines are completely normal. They are part of the design of equity investing. If you invest for decades, you are going to experience sharp corrections, bear markets, and probably at least one severe collapse. That isn't pessimism. That's just how markets behave. You need to think about downturns in 3 buckets. First, there are corrections, declines of around 10% or more. These happen regularly. They're uncomfortable but common. Second, there are bear markets, declines of 20% or more. These are more serious and tend to create real fear. And third, there are deeper crash-style events, where markets fall 30%, 40%, or even more in a relatively short period of time. 2008 was one. 2020 was another. The dot-com collapse was another. Different trigger. Same lesson. The market can fall hard. Investors can panic harder. And yet, across history, markets have also recovered, grown, and rewarded the people who kept compounding through the chaos. That's the mental shift you need to make. A crash is not evidence that long-term investing is broken. A crash is the price of admission for long-term investing. If you understand that, you stop being shocked by downturns. And once you stop being shocked, you can start preparing properly. Now let's get practical. If you want a crash to help your compounding instead of destroying it, you need a system in place before the headlines get ugly. Not during the panic. Not after your portfolio is already down 30%. Before. There are 3 things I believe every long-term investor should have ready. And the first one is the part most people ignore because it feels boring. The first rule of surviving a crash is simple. Never let real-life expenses force you to liquidate long-term investments at discounted prices. That's what an emergency fund is for. If your car breaks down, your income gets hit, or unexpected bills show up during a recession, you do not want to be pulling money out of your portfolio when the market is deeply red. Because once you sell during panic, you've done 2 things at once. You've locked in the loss, and you've removed your capital from the recovery. That's a double hit. A proper emergency fund protects your compounding by protecting your decision-making. It gives you breathing room. It keeps temporary life problems from becoming permanent investing mistakes. For most people, that means building a reserve of around 3 to 6 months of essential expenses in a safe, liquid account. No, it won't deliver stock market returns. That's not its job. Its job is to buy you time when the market is under pressure, so you're not forced to become a seller when everything is already on sale. Think of cash not as dead money, but as strategic stability. When everybody else is selling because they have no flexibility, your cash buffer gives you control. And control is one of the most underrated advantages in investing. The second move is to automate your investing. This is where compounding becomes powerful during a crash. Because when prices fall, you're fixed contributions by more shares. That means downturns can actually improve your long-term accumulation if you keep participating. Let's say you invest the same amount every month. When markets are high, you buy fewer units. When markets fall, you buy more units. And over time, your average cost can come down without you needing to predict tops, bottoms, or turning points. That is the beauty of systematic investing. It works because it removes the need to be clever. And during a crash, clever investors often become their own worst enemy. They wait for more confirmation. They wait for better visibility. They wait until things feel safe again. And by the time the market feels comfortable, prices are often already much higher. That's why automation matters so much. Because when fear spikes, the human brain wants to pause. It wants certainty. It wants to stop the pain. But your future wealth is often built in the moments that feel least comfortable in the present. If your investing is automated, you don't need to summon courage every month. Your system keeps working even when your emotions are unreliable. And that is exactly how disciplined investors quietly build larger positions during downturns while everyone else freezes. The third move is to make sure your portfolio is built to survive a crash, not just to look impressive in a bull market. A lot of people think they're diversified because they own several stocks. But if all those stocks are in the same sector, same country, or same growth theme, that's not real diversification. That's concentration wearing a disguise. Real diversification means spreading exposure across different parts of the market, so one collapse doesn't drag down your entire financial future. That may include a broad domestic equity base, some international exposure, a stabilizing fixed income component depending on your risk profile, and possibly other asset classes that reduce overdependence on one area. Why does this matter for compounding? Because diversification gives you two benefits. First, it reduces the odds that one catastrophic segment destroys years of progress. Second, it creates the ability to rebalance. And rebalancing is one of the most underrated compounding tools in investing. When one part of your portfolio falls sharply and another part holds up better, rebalancing forces you to do what most people never do naturally. Trim relative winners and buy relative losers. In other words, it creates a disciplined buy-low mechanism. Without that framework, most investors chase what recently worked and avoid what just dropped. That behavior feels natural. It also sabotages returns. A diversified portfolio may feel less exciting in euphoric markets, but it tends to be far more durable when conditions reverse. And durability is what allows compounding to keep working year after year. Now let's talk about the part that determines whether any of this actually works. Psychology. Because during a crash, the numbers are only half the story. The other half is what those numbers do to your brain. When your portfolio falls hard, it doesn't feel like a spreadsheet problem. It feels personal. It feels threatening. It feels like something must be done immediately. That's why so many investors abandon perfectly solid strategies in terrible market environments. Not because the strategy failed, but because the discomfort became too intense. This is where loss aversion takes over. People feel losses more deeply than equivalent gains. A 20% decline doesn't just register as a normal fluctuation. It can feel like proof that everything is going wrong. And once that fear gets amplified by headlines, social media, and constant red numbers on a screen, rational thinking gets weaker. So how do you solve that? You don't solve it by pretending fear won't show up. You solve it by making key decisions before fear arrives. That means writing down your investing rules now. What are you invested in? Why are you invested in it? What is your time horizon? What will you do if the market falls 20%? What will you do if it falls 40%? Will you keep buying? Rebalance. Hold. Make those decisions in a calm environment, not in the middle of a sell-off. Because if you wait until the crash to figure out your strategy, your emotions will write the plan for you. And emotions are terrible portfolio managers. Let's bring this together with the bigger picture. The investors who build the most wealth through crashes are usually not the ones making the boldest predictions. They are the ones who remain invested, keep buying, and avoid self-inflicted damage. That's it. Crashes create lower prices. Lower prices create better future expected returns for disciplined buyers. And recoveries often begin when the average investor still feels nervous, confused, or outright bearish. That's why missing only a small number of strong rebound days can have a major impact on long-term performance. The market does not send a polite invitation before it turns around. Recovery often starts while fear is still high. So if you sell during the collapse and wait to feel comfortable again, there's a good chance you re-enter later, at higher prices, after doing the opposite of wealth building. This is why crash preparation matters so much. Not because you'll avoid volatility, but because you'll stop reacting to it in ways that damage compounding. A crash does not automatically make you poorer. A crash combined with panic usually does. A crash combined with preparation can do the opposite. So let's simplify everything we covered. If you want to use compounding to build more wealth during a market crash, remember this. First, crashes are normal. They are not rare glitches in the system. They are a recurring feature of investing. Second, compounding only works if you stay invested long enough. Interrupting it with emotional selling is where real damage happens. Third, your system matters more than your predictions. Build a cash buffer so life doesn't force you to sell. Automate your investing so fear doesn't stop you from buying. Diversify and rebalance so one concentrated bet doesn't destroy years of progress. And finally, write your plan before the market tests you. Because when the next crash arrives, your success will not depend on how motivated you feel that day. It will depend on whether your system is stronger than your emotions. The truth is, market crashes don't create disciplined investors. They reveal them. When prices are rising, almost everyone feels smart. But when markets fall hard, that's when the difference shows up. One group sees pain and runs. The other sees discounted future compounding. And over time, that difference becomes massive. If you prepare correctly, the next downturn does not have to be the moment your progress breaks. It can be the moment your long-term wealth accelerates. That's the real opportunity. If you enjoyed this breakdown, this is exactly what we do here on Matt Fin Lab. Clear, practical, data-driven finance content built to help you make better decisions with your money. Subscribe, and I'll see you in the next one. And as always, this video is for educational purposes only and is not financial advice.